You walk into a bowling alley and the math looks simple. There's a building, there are 40 lanes. Each lane rents for maybe $6 a game, times 4 people, times however many frames they roll before they get bored or their arms get tired. Multiply that by a Friday night crowd and it looks like you found a quiet little cash machine hiding in a strip mall. Buy the building, buy the pin setters, open the doors, and the games pay for themselves. That's the version most people carry around in their head. It's also almost completely wrong. And the gap between that version and reality explains why a business that looks recession-proof, cheap entertainment, indoors, appeals to families and drinkers alike, has spent the last 60 years alternating between explosive growth and mass extinction. To understand why, you have to stop thinking of a bowling alley as a place where people bowl, and start thinking of it as a piece of real estate that happens to have bowling in it. That distinction is the whole story. Start with what a lane actually earns. Rent a lane for an hour, split 4 ways, and you're talking about a few dollars per person for 60 minutes of entertainment. That's a terrible hourly rate for a business that has to heat, light, insure, and staff a building the size of a warehouse. A single automatic pin setter, the machine that resets the pins after every frame, is a complex piece of mechanical equipment that needs regular maintenance, and a 40-lane center needs 40 of them. None of that gets paid for by $6 games. So what does pay for it? At Bolero, the largest bowling operator in North America, roughly half of revenue comes from bowling itself: league play, walk-in games, shoe rental. The rest comes from something else entirely. Food and beverage makes up roughly a third of revenue, and arcade games and amusements add another chunk on top of that. Put plainly, the bar tab and the chicken tenders are pulling close to as much weight as the sport the building is named after. This is the first thing that should reframe how you see the business. The bowling itself functions less like the product and more like the reason people show up. It's the hook that gets a group of 8 people to walk through the door and stay for 2.5 hours, during which they'll order beer, share nachos, and feed $20 into a claw machine. The lane rental is almost incidental to what actually shows up on the register at the end of the night. A healthy-looking bowling business is, underneath, a bar and an arcade that happens to rent out lanes as the excuse to keep people in the building. That single fact changes everything about how you'd actually run one of these places. If bowling itself barely moves the needle, then the real skill in operating a bowling center isn't teaching people to throw a strike, it's designing a building people want to linger in. To understand why so much of this industry has gone bankrupt more than once, you have to go back to the invention that made modern bowling possible in the first place: the automatic pin setter. Before it existed, bowling alleys employed teenage boys called pin boys who crouched behind the lane and reset pins by hand between frames, which capped how many lanes any one building could realistically run. In the mid-1940s, a machine that could pick up and reset pins mechanically changed that constraint entirely. One company built its empire on this patent: AMF, originally an equipment manufacturer for the tobacco industry that pivoted hard into bowling technology. Once pin setting was automated, the ceiling on how big a bowling business could get essentially disappeared. Centers could run more lanes with less labor, and league bowling exploded into one of the most popular participation activities in the country through the 1950s and 60s. That growth attracted a wave of construction. Alleys went up in suburbs across America on the assumption that demand would keep climbing in a straight line. It didn't. League participation, which had been the backbone of the industry's revenue, began a long decline in the decades that followed, as the same generational shift that hollowed out bowling leagues also hollowed out church groups, union halls, and Rotary clubs. The broader decline of what sociologists call associational life, of people organizing their free time around a fixed weekly commitment with the same group of neighbors. Bowling had ridden that wave up. It rode the same wave down. But the buildings didn't disappear when the leagues thinned out. Thousands of 40- and 80-lane centers were still standing, still carrying mortgages and equipment costs sized for an era of packed Tuesday night leagues in a country that increasingly wasn't showing up on Tuesday nights. That mismatch, fixed, expensive infrastructure built for peak demand, sitting through a long demand decline, is the mechanical root of almost every bankruptcy this industry has produced since. And nobody demonstrates it more clearly than the company that invented the machine that started the boom in the first place. AMF spent decades as the dominant name in bowling, both as an equipment manufacturer and, eventually, as an operator running hundreds of centers itself. By the late 1990s, it was the largest bowling center operator in the world, running well over 500 centers across the US and other countries. On paper, that scale looked like strength. the biggest player in an industry with real brand recognition, real estate in hundreds of markets, and a product America had loved for generations. But look at how that scale was built, and the picture changes. Through the 1990s, AMF went on an aggressive acquisition spree, buying up roughly 260 bowling centers in just a couple of years at a cost approaching $500 million, financed heavily with debt as part of a private equity-style buyout. That's the part that matters. The expansion wasn't funded by bowling's profits. It was funded by borrowed money, on the bet that a declining participation sport could still support an aggressively leveraged real estate empire. It couldn't. By 1999, with losses mounting, AMF was closing plants and warehouses and posted a net loss north of $200 million on revenue of about $700 million. Its stock, which had traded on the New York Stock Exchange, fell below $1 a share and was delisted. By mid-2001, carrying more than $1 billion in debt, almost exactly what it had cost to buy the company in the first place 5 years earlier, AMF filed for Chapter 11 bankruptcy. It emerged the following year with its debt restructured, but the underlying problem hadn't gone away. In 2012, saddled with debt again and still facing a declining sport, AMF filed for bankruptcy a second time. Here's the detail that makes this more than just a story about one unlucky company. AMF's bankruptcies weren't caused by a sudden collapse in demand for bowling. Participation had been softening gradually for decades, a slow leak, not a burst pipe. What actually broke the company was debt layered on top of that slow leak. A business with declining, but still substantial cash flow can survive for a long time. A business with declining cash flow and $1 billion of acquisition debt cannot. The lanes didn't kill AMF. The balance sheet did. That distinction between a business dying from lack of customers and a business dying from the cost of the debt used to grow it is the pattern that shows up again and again in this industry, and it's the exact same playbook that built AMF's successor. Here's where the story loops back on itself in a way that's almost too neat. The company that eventually absorbed much of AMF's footprint and became the dominant operator in North American bowling is Bowlero, formed in 2014 and backed by private equity money from firms including Apollo Global Management. Bowlero's strategy wasn't to bet that bowling participation would rebound. It was to recognize that the industry was full of distressed, undercapitalized independent operators sitting on valuable real estate, and to buy them up cheap. By the time Bowlero went public through a SPAC merger in 2021, a deal valuing the combined company at roughly $2.6 billion, it already controlled more than 300 centers, making it about 8 times larger than its nearest competitor in a market where more than 3,000 independently owned centers still existed. That fragmentation is the opportunity. A mom-and-pop operator running one 40-lane building with 1990s carpet and a broken jukebox has no leverage, no marketing budget, and often no way to refinance. A well-capitalized roll-up can buy that building, renovate it into a louder, darker, cocktail-forward entertainment venue, and extract far more revenue per lane than the previous owner ever could. And the acquisitions kept coming. Bowlero added dozens of centers year after year, eventually absorbing the Lucky Strike chain, and in 2026, rebranding its entire portfolio under the Lucky Strike Entertainment name. By the mid-2020s, the company was generating over $1 billion in annual revenue with operating margins, EBITDA margins in the neighborhood of 30%, that would be the envy of most restaurant or retail chains. That's a genuinely striking number for an industry widely assumed to be dying. So which is it? Is bowling a declining relic or a business generating restaurant crushing margins? The uncomfortable answer is both. And the reason both can be true at once is the same reframe from earlier. This isn't really a bowling business anymore. It's a real estate and hospitality business wearing bowling's name. Bowlero has deliberately pursued ownership of the land and buildings underneath many of its centers rather than leasing them, treating bowling less as the product and more as the anchor tenant that justifies owning valuable commercial real estate in the first place. Combine owned real estate, food and beverage margins that dwarf a $6 game rental, and a scale advantage that lets you negotiate better supplier pricing than any independent alley ever could, and you get a company that can post strong profits while the underlying sport keeps shrinking. That consolidation, though, carries its own hidden cost, and it's showing up right now. Because Bolero, now Lucky Strike Entertainment, has grown so dominant, controlling roughly a third of total U.S. bowling revenue, there are local markets where the company effectively owns nearly every lane in town. In May 2026, a group of bowlers filed a class action lawsuit, accusing the company of using that market power to push prices sharply higher, with claims that included families being quoted several $100s for a couple of hours of holiday bowling. And one Seattle customer allegedly charged close to $300 for a 2-hour session. The lawsuit alleges antitrust violations, arguing that in markets where the company controls the overwhelming majority of lanes, competitive pricing pressure simply doesn't exist anymore. Whether that lawsuit succeeds is a separate question from what it reveals about the underlying economics. It reveals that the roll-up strategy, which rescued the industry from AMF-style bankruptcy, carries an inverse risk. Once you've consolidated enough of a fragmented, declining market, your profit growth increasingly depends less on getting more people to bowl and more on charging the people who still show up considerably more per visit. That's a sustainable strategy right up until customers or regulators decide it isn't. A shrinking sport propped up by rising prices in a shrinking number of hands is a very different growth story than bowling is back. So what does this actually mean for anyone looking at this industry today? An investor, an entrepreneur, or just someone trying to understand why the bowling alley from their childhood either turned into a luxury lounge or turned into a Planet Fitness? The optimistic outcome is the one Bolero is currently living. Consolidate a fragmented, real estate-rich industry, extract food, beverage, and events revenue that a sport-focused operator never would have prioritized, and end up with margins that look nothing like a dying business. In that version, bowling never has to grow again. The company just needs to keep monetizing everything around it. The realistic, harder version is what most independent operators actually face: a business with real fixed costs, pin setter maintenance, staffing, insurance, a building sized for an era of packed leagues, competing against declining participation, and increasingly against a dominant competitor with more capital and more pricing power. Survival in that version usually means becoming something other than a pure bowling alley, adding a bar that could stand on its own, adding event and party bookings that fill dead midweek hours, effectively becoming a hospitality business that tolerates bowling rather than one built around it.
The failure case is AMF's case, twice over. Growth financed by debt that assumes participation will hold steady or rebound, colliding with a slow, structural decline that debt payments don't care about. It's not a dramatic collapse. It's a company that looks fine on the surface. Hundreds of locations, a recognizable brand, millions of annual visitors, right up until the debt service and the declining underlying demand meet in the same fiscal year, and the story turns into a bankruptcy filing that outside observers treat as sudden, even though the pressure had been building for a decade.
Go back to the opening picture. The building, the lanes, the pin setters, the $6 games that supposedly pay for it all. That version isn't wrong because bowling isn't popular anymore. It's wrong because it mistakes the product for the business. The lanes are the stage, the bar, the arcade, the birthday parties, the corporate events, and increasingly, the land underneath the building are where the actual economics live. The companies that have survived this industry's long, slow decline in participation are the ones that stopped trying to sell bowling and started selling an evening out that happens to include it. And the ones that failed are almost always the ones that borrowed heavily to bet the opposite was still true. A bowling alley was never really in the business of bowling. It was always in the business of getting a group of people into a building for a few hours and finding every possible way to keep them spending money while they were there. Bowling just happened to be the best excuse anyone ever came up with to do that.